Hello, my name is Ellen Elfke, and I am the Outreach and Public Affairs Coordinator for the Minnesota Farm Service Agency, or FSA. This presentation will provide an overview of FSA farm loan programs and options. As previously mentioned, FSA has two major categories of offerings: farm programs and farm loan programs. FSA has a variety of loan programs to meet different types of needs, whether it be for an improvement project, expanding an enterprise, getting started, or purchasing a farm. We will discuss each of these programs as we get further into the presentation. Farm loan programs often open the door for many beginning farmers and veterans to get started farming. Building a successful farm is a significant financial investment and can be especially challenging for beginning farmers who are not financially ready to access credit from commercial lenders. So, enter the Farm Service Agency as the lender of first opportunity. While FSA is fully committed to all farmers and ranchers, there is a special focus on the credit needs of farmers and ranchers who are in their first 10 years of operation. Our goal is to help you grow and graduate from progression lending to conventional lending. To emphasize progression lending, you will work very closely with your loan official, so be sure to have honest and open communication, as it is their job to assist you. The 5 C's of credit, which are character, capital, collateral, conditions, and capacity, are very important to you and your operation, as it is imperative to stay on top of your credit, cash flow, and finances. While FSA does not make an approval decision based solely on credit score, it is important to maintain a good score. Instead of focusing so much on the overall score, FSA will look at the credit history, so your payment schedules and past due accounts. All of these things are important to ensure the success of your farming operation and repayment of loans. When thinking in terms of FSA programs and services, a beginning farmer or rancher has not operated a farm or ranch for more than 10 years at the time of application. An additional requirement for FSA beginning farmer real estate programs is that the farmer owns less than 30% of the average farm size in the county where the farm is headquartered. Beginning farmers have priority in loan funding, as there is a specific allocation of funds that is specifically targeted towards beginning farmers and ranchers. There is also a certain loan type, the Beginning Farmer Down Payment Loan Program, that only beginning farmers and ranchers are eligible for. This loan category utilizes a much lower interest rate, which can be very attractive when compared to other loan options. FSA has 2 types of farm loans, direct and guaranteed. Under both the direct and guaranteed categories, however, FSA offers both operating and farm ownership loans. FSA works one-on-one with an applicant to determine creditworthiness, ability to repay, evaluate the farm business, and supervises them through the loan process. Applicants and borrowers maintain good and frequent communication with their FSA farm loan officer and team. Your loan officer will work to create the best solution for you in terms of payment schedules, accountability, loan terms, and disbursement of funds. FSA loan staff can provide the technical assistance and can answer questions, but it is important to understand that the borrower is ultimately responsible for the success of the operation. The FSA staff will work with you in filling out your application and applying, so please take advantage of their assistance when applying for a loan. Be realistic, honest, and detailed in your description of your personal and farm finances and your business plan and expenses. Decisions are made based on the information you provide, so it is important that it is accurate. Many loan officers will recommend starting small and scaling up the operation. Basic eligibility requirements that an applicant must meet to obtain an FSA farm loan are as follows: must be unable to obtain credit elsewhere, be a citizen or a legal resident alien, have acceptable credit history, be the owner-operator of a family farm, show sufficient training and management ability, must show ability to repay the loan through a feasible cash flow plan, and must have adequate security for the loan. Regular farm ownership loan funds can be used to purchase farm real estate, make capital improvements to real estate, improve soil and water conservation, and pay loan closing costs and related expenses. However, regular farm ownership loan funds cannot be used to refinance existing debt. The maximum loan amount under a regular farm ownership loan is $600,000, and the maximum term would be up to 40 years. FSA can provide 100% financing or can work in participation with another lender. And no down payment is required under the regular farm ownership program. Joint financing is when FSA provides a portion of the credit, up to $600,000, and another private or commercial lender provides the remaining financing. Through FSA, the interest rate for the portion we lend is at 3%. We finance 50% of the loan amount or less with up to a 40-year term. We take a second lien on the property and may need additional security or assets to meet our requirement of having the loan 150% secured. The down payment farm ownership loan option is a great program designed to help beginning, veteran, and SDA or socially disadvantaged farmers. The terms are a bit different from the direct farm ownership loan program, as there is a 5% minimum down payment required. FSA's portion of the loan has an interest rate of 1.5%, and the maximum loan amount is $300,150, and the maximum term limit would be 20 years as opposed to 40. FSA finances 45% of the loan, and the remaining 50% is covered by a commercial lender with a minimum amortization period of 30 years. This interest rate is negotiated with the participating lender. FSA also offers direct operating loans. These loans can be used for annual operating expenses, to purchase breeding livestock or machinery, or to refinance non-real estate farm debts. The maximum lending limit is $400,000, and the term is 1 to 7 years based on the purchase. Annual operating loans have a repayment period of 1 year, but livestock and equipment purchases could go up to that 7-year term. FSA can also make low-interest loans to youth to establish and operate agricultural-related, income-producing, supervised projects. The maximum loan amount is $5,000, and the loan must be repaid within 7 years, but the repayment schedule is worked out with the loan officer and tailored to the specific project. Loan collateral consists of crops, livestock, equipment, and/or other items purchased with loan funds. And it is important to note that a loan to raise livestock or crops must be repaid when the commodity is sold. Anyone between the ages of 10 to 20 years old can request a youth loan. The applicant must be a United States citizen and must have an advisor who agrees to provide supervision or oversight of the project. Loan funds can be used to buy livestock, seed, equipment, and supplies, buy, rent, or repair needed tools and equipment, or pay operating expenses for the project. Microloans are limited to $50,000 and have a simpler application process and less paperwork. There are both farm ownership and operating microloans. Operating microloans can be used for all approved operating expenses authorized by FSA, such as initial startup expenses, seed, fertilizer, marketing, livestock, etc. Ownership loans can be used for approved expenses, such as purchasing land or a farm, enlarging an existing farm, constructing buildings, paying closing costs, etc. Operating loans repayment terms are 1 to 7 years, while the farm ownership loans can go up to 25 years. Microloans have been very beneficial for beginning farmers. We at FSA have seen a high volume of participation in this program amongst special groups since its inception. In addition to direct farm loans, FSA also works with agricultural lenders to provide guaranteed loans. Guaranteed loans are made and serviced by agricultural lenders, so Farm Credit, your local banks, and are funded by the lender. They are often used to help lenders continue with customers who have experienced setbacks, as that guarantee acts as an insurance policy for that lender. To qualify for an FSA guarantee, the loan applicant must meet general eligibility requirements, be unable to obtain the loan without a guarantee, and have a feasible plan and adequate collateral as determined by the lender. Guaranteed operating loans have 1 to 7 year terms, while ownership is up to 40 years. The loan rate is determined by the lender and not FSA, but the loan limit is $2,037,000. The lender essentially becomes FSA's customer, as the borrower works directly with the lender and not FSA. The 2018 Farm Bill increased the loan guarantee for beginning and underserved farmers from 90 to 95%. FSA farm loan interest rates are set at the first of each month. Here are the current rates for January 2023. Direct farm operating loans are at 5.125%. Direct farm ownership loans are at 5.25%. Joint financing farm ownership loans are at 3.25%, and the beginning farmer down payment farm ownership loans is set at 1.5%. And that provides an overview of the FSA Farm Loan Program options. Anyone is welcome to reach out to our state office via the contact information here on the screen with questions about programs, getting started with our agency, or locating the closest FSA office to you. We are more than happy to assist you in acquiring program information and or to connect you with the local FSA staff in your area. Thank you for learning about FSA farm loans.